I want to show you this screenshot that I took from last year. Did you know that 37% of US households have either a traditional IRA or Roth IRA? And of that 37%, only 12% actually contributed to either a traditional IRA or Roth IRA. And I want to encourage you who's watching this video live or on replay to share the video with your friends, your parents, your teenagers, and other family members, because having a Roth IRA could seriously make a big difference in your retirement. And I know not everyone has room in their budget to maximize their Roth IRA contributions. I understand that. But there are people who don't contribute to the Roth IRA simply because they don't know that they could contribute to the Roth IRA at the same time they contribute to their 401k, 403b, 457, or TSP. And if you look at this diagram here, it's one of our top 5 retirement accounts, and along with 401k and health savings account, or what's known as HSA. My wife has her own Roth IRA and HSA, and I have my own as well. And it's not that we don't like to combine our financial accounts, but the IRS actually states that we cannot combine our IRAs or any type of retirement accounts. And each of the accounts has to be assigned an individual social security number. We also have the 401k and TSP that we contribute to the maximum every year so that we can secure our retirement after age 60. But we make our Roth IRAs our priority over maximizing our contributions to our TSP or 401k. Here's how we prioritize our investments. We haven't changed the priority of our investments since we truly started investing in 2017. Our number one priority is to get the employer match with the TSP, which is the federal government version of the 401k. And since most people don't know what a TSP is, I'll just label it as 401k. And once we get the employer match with my 5% personal contribution. But before I get into my investments, it is time for you to ditch the bulky wallet and check out this carbon fiber card holder from Ekster that can hold up to 15 credit cards and your ID cards. Ekster creates next generation wallets, bags, and other accessories that are made in vegan recycled leather. Forbes even did a review article that Ekster is the most successful smart wallet brand in the world with RFID protection. You can even add a tracker card to keep track of your wallet if you can't find it in your house. Ekster will give you an exclusive discount of 30% by visiting shop.ekster.com/firesidechat. Again, that's shop.ekster.com/firesidechat to enjoy 30% off until April 29th. And thank you, Ekster, for sponsoring this video. Then I move on to the HSA and contribute up to the maximum, which is $7,750 for family coverage or $3,850 for individuals in the year 2023. The next one is our Roth IRA, which is $6,500 each for me and my wife. So a total of $13,000. And after we max out our Roth IRA and HSA, then we go back to our 401k to maximize the rest of the contribution. The maximum personal contribution limit is $22,500 for the year 2023 for the 401k, TSP, 403b, or 457. And we're doing that with my wife this year. And after we maximize our retirement accounts, then we move on to the taxable investment accounts for our early retirement. And let me ask you this. What if you could have an extra $20,000, $40,000, or $60,000 in tax-free money in your retirement? What if you could withdraw your Roth IRA in your 40s or 50s, way before you reach the Social Security retirement age at 62? And did you know that your Roth IRA is completely separate from your employer-sponsored retirement accounts, like your 401k, 403b, 457, or TSP? So you can contribute to your IRA on top of your 401k. And surprisingly, a lot of people don't know that. And if you're married, you and your spouse can each contribute to the Roth IRA, and your stay-at-home spouse can open up what's called a spousal Roth IRA account and start contributing as long as you and your spouse are filing your taxes jointly and staying under the income limits. And I'll talk more about that later on in the live stream. So anyway, let's talk about how Roth IRA works. So you have an individual or joint checking account, right? A checking account is where you get your paychecks and pay your bills. When you get your paychecks from your employer deposited into your checking account, you've already paid federal income tax, FICA, Medicare, and maybe state income tax, right? So assuming you already paid taxes on the money you have in your checking account, you can do a direct contribution or transfer from your checking account to a Roth IRA if you're under the income limit that I'm going to talk about next. So the money Roth IRA is receiving from your checking account is assumed to be taxed. Okay. We call that the after tax contribution. And keep in mind that your contributions are not tax deductible because you already pay taxes on it. And once you transfer your money into a Roth IRA, it's not invested yet. It's just parked in a money market account that barely accrues any interest. It's just like a savings account inside a Roth IRA with a terrible interest rate. And you can also do automatic schedule investments if you have a mutual fund inside your Roth IRA. But I'll also talk more about that later on in the live stream. So you can contribute up to $6,500 for the tax year 2023, which means from January 1st, 2023 until the tax deadline on April 15, 2024, you can contribute that $6,500 from your checking account to your Roth IRA. And after the tax deadline on April 15, 2024, you cannot contribute that 6,500 anymore to the tax year 2023. And if you're 50 or older, you can contribute an additional $1,000 as a catch-up contribution, or a total of 7,500. Just remember that if you over contribute to your Roth IRA, the IRS will penalize you 6% on excess contributions if you don't make the withdrawal by the time you file your taxes. And you don't have to make a lump sum contribution of 6,500 or 7,500 from your checking account to the Roth IRA. You can dollar cost average your contributions by making monthly or biweekly contributions like $250 every 2 weeks or $540 every month. It's completely up to how you want to set it up with the brokerage account that manages your Roth IRA. And as far as what brokerage account to invest in your Roth IRA, I'm going to have a video coming out on Friday that ranks from best to worst brokerage accounts between Schwab, Fidelity, Chase, and Vanguard based on my experience. So be sure to subscribe if you haven't done that already. And don't forget to download my financial independence resources for absolutely free by visiting firesidechat.com/resources. And you can also check out my the Fireside Chat shop. And if you want to buy books and equipment or whatever, everything that I have in my studio by visiting firesidechat.com/shopping. Okay. So let's talk about eligibility to open a Roth IRA. Anyone can actually open a Roth IRA as long as they're at least 18 or maybe 21 years old in some states. And if you're under the age of 18, then you need to have your parents open what's called a custodial Roth IRA for you. And I made a video about that on my channel. And so you can just search for Fireside Chat Custodial Roth IRA. You can check that out. But as far as the eligibility to contribute directly to the Roth IRA, there are income limits set by the IRS. And the reason they have an income limit is that Senator Roth, back in the 90s, at the time, when he was in Congress, he didn't want rich people to shelter money in a tax-free retirement account. Obviously, it didn't work out so well because they found a tax loophole called a backdoor Roth IRA, which I'll talk more about that later on. But the bottom line is that anyone can open a Roth IRA, but to directly contribute to the Roth IRA from your checking account to the Roth IRA, right? What I just talked about, you need to be under the IRS income limits. And keep in mind that the income limits change every year to adjust for inflation. So you need to make sure that you're eligible to contribute to a Roth IRA. For the tax year 2023, if you're single, your modified adjusted gross income has to be under $138,000. And the phase out range is $138,000 to $153,000. And what that means is that if you're in the phase out range, you can only contribute up to a reduced amount from the total of $6,500. So if you're making more than $153,000 a year in modified adjusted gross income, then you're not eligible to contribute to a Roth IRA. And if you're married and filing your taxes jointly, your modified adjusted gross income has to be under $218,000. And to contribute the full $6,500 for each spouse. The phase out range starts at $218,000 to $228,000. If you make more than $228,000 in modified adjusted gross income, then you're now eligible to contribute directly to the Roth IRA. But don't get discouraged, because there is a separate strategy called a backdoor Roth IRA for high income earners. And I will talk more about that later on. So let me show you this chart from Schwab. And I know it looks really complicated, but it really isn't. So what happens here is uh, basically talks about the phase out range. And so if your modified adjusted gross income, let me see if I can zoom in here. Cannot zoom in. Okay, sorry about that. I know the screen is a little small, but I cannot zoom in. I'm going to go and highlight it here. Say it's $141,000 in 2023. Then you're only eligible to contribute up to $5,200 out of the 6,500 maximum. You see how as your income increases, the eligibility to contribute directly to the Roth IRA decreases, and making $148,500 right here will only allow you to contribute up to $1,950, and you'll need to do the backdoor Roth IRA conversion for the rest of the $4,550. Does that make sense so far? Let me know in the comment section down below. So this column here is for single filers, and the next column is for married filing taxes jointly. And the next one here is the married filing separately. So if you're filing your taxes separately with your spouse, you pretty much don't have any ability to contribute to the Roth IRA, and instead do the backdoor Roth IRA. And a lot of people actually wait until the end of the calendar year in December to make the Roth IRA contributions or the backdoor Roth IRA conversions, because they're not sure what their income is going to be. And I've done that in the past when I switched jobs, because I wasn't sure about my how much of my overtime pay was going to increase my modified adjusted gross income. So what I did that year when I switched jobs was put that Roth IRA money in a separate savings account every month until December, when I realized how much money I had made that year. So you could park that $6,500 in a high yield savings account, and right now they're yielding like 3.75 or 4% in APY, until you can figure out your modified adjusted gross income for 2023. That's a good question. Okay, so how do I figure out my adjusted gross income? About to draw on this iPad here. Good question. So keep in mind that I'm not a CPA, so I'm just going to share what I know. You can always look at your previous tax return statement on 1040 and do a control find for modified adjusted gross income. And it's usually on the IRA deduction worksheet that your CPA prepped. So before you figure out what your modified adjusted gross income is, you'll need to figure out your adjusted gross income. Okay, so I'm going to put AGI. Okay, so let's say you made $150,000. Okay, let me see. So let's say your adjusted gross income is $150,000 in gross income this year before taxes and deductions. And that's from your W-2, 1099, rental income, dividend income, or capital gains, all added up together, right? Your deductions like educator expenses, student loan interest, alimony payments, and traditional 401k contributions will lower your taxable gross income. So let's say your deductions are, we'll just call it $20,000. Okay. So that gives you $130,000 in adjusted gross income. Okay. So this one is gross. Your deductions and adjusted gross income is now $130,000. Your adjusted gross income doesn't include the annual standard tax deduction of, what is it, $13,850 or $27,700. Let me know if I'm wrong on that. Correct me if I'm wrong in the comment section, okay? For modified adjusted gross income, you'll need to add certain deductions back to the adjusted gross income. So it's your AGI, maybe plus student loan interest, tuition, and fees deduction, or certain foreign income. You can go to the IRS website. They actually have a whole list of all the eligible deductions. So your MAGI, okay, could be the same as the AGI, and it should tell you that on 1040 when you file your your tax return for 2022. Great question, though. And I am not a tax specialist or CPA, so please consult with your own CPA to figure out your modified adjusted gross income. So the IRS uses MAGI, modified adjusted gross income, to figure out if you qualify for a specific tax programs or benefits like the Roth IRA. But this is just for the Roth IRA contributions, not the conversions or rollovers. Let me show you how they work. Okay. So this part is very important for you to understand. Super duper important. So please pay attention as much as you can. All right. A contribution that I talked about to your Roth IRA is what you directly contribute. Okay. So that's your contribution, right? So that's what you directly contribute or transfer from your bank checking account to your Roth IRA. And a conversion is if you decide to pay taxes on what you have in your traditional IRA or other pre-tax retirement accounts, and then you convert that money over to your Roth IRA. So anytime you do a conversion, you'll have to pay income taxes on the total conversion in the same year. A rollover is when you directly move money from Roth 401k, Roth TSP, or other Roth IRA that you may have, transfer directly to your Roth IRA. And you won't have to pay any taxes on the rollover because you already paid them. It has to be a Roth to Roth rollover so the IRS can't tax you twice. You can't do a rollover from Roth to traditional because you already pay taxes on the contributions. Earnings in your Roth IRA are however much you earn from investing in a mutual fund, ETF, bonds, stocks, or other qualified securities in accordance with the IRS. You cannot withdraw your earnings and interest tax-free or penalty-free until you turn 59 and a half. So this is the only one that you have to wait until you're 59 and a half, okay? You can, however, withdraw your contributions at any time. So I'm going to give you an example. Let's say you contributed 6,500, okay? And you made some incredible investment return and you got $500 back from interest and earnings from investing in your Roth IRA. But I can withdraw this 6,500 at any time, tax-free and penalty-free, right? But if I withdraw this $500 before I turn 59 and a half, then I'll have to pay 10% in penalty and the income tax on the $500 in earnings and interest for the early distribution. And on the tax statement, it's going to say something like unqualified distribution or something like that. And it's going to trigger a taxable event and a 10% penalty. So the common misconception about the Roth IRA is that if you open one and contribute to it, you're not going to see it until you're 59 and a half. What you probably didn't know is that you can take your money out at any time, tax-free and penalty-free, because again, you've already paid taxes on it, right? That's the money you can withdraw at any time. The only money you'll get penalized and taxed on is the earnings and interest and dividend payments that are accrued inside your Roth IRA. So you're not locking down your money in your Roth IRA until you're 60 years old.